Imagine sitting at your trading desk. You watch price crawl up to a major resistance level you've been tracking for days. It hesitates, wicks slightly above, then explodes higher. Your heart beats faster. You think, finally, this is the breakout I've been waiting for. You rush to enter. Moments later, bam, a savage reversal. Your stop loss is shredded, leaving you staring at a red line across your screen. And then, as if mocking you, price resumes upward and keeps going without you. This is the infamous trap known as a liquidity sweep, or what some traders call a turtle swap. It's a test of your patience, your plan, and ultimately your psychological resilience. A turtle swap or liquidity sweep isn't just a technical maneuver, it's psychological warfare. Market makers and large institutions have one mission: find liquidity. They know where retail traders keep their stops, where they'll jump in with FOMO and where they'll panic out. By pushing price slightly beyond an obvious level, they create what looks like a breakout. This triggers buy stops above resistance or sell stops below support. Once that liquidity is absorbed, price whips in the opposite direction, leaving traders stuck. For trend followers, this is deadly. Trend systems often rely on breakout entries. But if you don't learn to spot sweeps, your edge turns into a bleeding wound. The human mind is conditioned to believe in linear cause and effect. Price breaks resistance, it will keep going up. But markets are not linear. They are dynamic, manipulative, and designed to exploit human emotions. Fear of missing out, FOMO, is the first hook. You watch price hesitate, then surge. You think, if I don't get in now, I'll miss the move. This narrative is designed to push you into impulsive decisions. The need to be right is another trap. You believe you know the market will continue higher. You forget that the market doesn't care what you believe. The addiction to constant action is the final nail. You don't want to wait for confirmation. You crave excitement, movement, action. But real profits come from stillness, from waiting, from reacting, not predicting. Rule number 1. Wait for retest confirmation. The most powerful traders are often the quietest. They watch patiently as price tests a level. When price first breaks out, it's noisy. Everyone piles in. But if it returns to the breakout point and holds, that's when the real story begins. A retest confirms the market's commitment to the new level. If it holds, buyers step in again, validating the move. If it fails, it was a sweep. A trader who waits for this retest avoids the emotional roller coaster of fakeouts. They enter when risk is lower and conviction is higher. Rule number 2. Define your invalidations before entry. Professional traders live and die by one question. Where does this trade become wrong? Defining your invalidation means knowing the exact point where your setup fails. Not after a gut feeling. Not after you hope it will turn. Write it down. Mark it on your chart. Commit to it before you enter. When a liquidity sweep occurs, it usually hits invalidations fast. This is good. It protects you from larger losses and keeps your mental capital intact. Losing small is a superpower. Most traders fear losing, but professionals understand that small, defined losses are the price of admission to long-term profits. Rule number 3. Use volatility-based position sizing. Richard Dennis and the original Turtles understood this deeply. They sized their positions based on market volatility, the so-called N value. Volatile markets mean wider stops and smaller positions. Quiet markets mean tighter stops and potentially larger positions. A liquidity sweep often happens after periods of low volatility. Price gets compressed like a spring. When it releases, it's violent and fast. If your position is too big, that violence magnifies emotional stress. Your mind screams, "Get out," at the first sign of trouble. By sizing positions appropriately, you reduce fear and noise. You give the trade space to breathe, which is critical for trend following. Rule number 4. Be the second mouse. An old market saying goes, the early bird gets the worm, but the second mouse gets the cheese. The first breakout often fails. The first mouse gets trapped. But if you wait, watch the reaction, and only step in after confirmation, you become the second mouse. You avoid the trap and claim the real reward. This requires humility. You don't need to catch the exact bottom or top. You just need to catch the meat of the move. Rule 5. Emotional discipline beats technical perfection. Many traders spend years chasing the perfect system. They think, if I just find the perfect indicator, I'll never get swept again. This is a lie. No system can protect you from your emotions. Only discipline can. Richard Dennis famously said, I always say you could publish my trading rules in a newspaper and no one would follow them. The key is consistency and discipline. He understood that human nature, not technical setup, is the true battlefield. Discipline means respecting your invalidations, sticking to your plan, and not acting on impulse. It's boring. It's repetitive. And that's why it works. Rule 6. Avoid predicting, start reacting. Predicting is seductive. It makes you feel powerful and smart. But it's a trap. Turtle traders were taught never to predict the market. Instead, they reacted to price behavior. They entered only when the trend was confirmed by their breakout and volatility rules. Prediction relies on ego and imagination. Reaction relies on observation and evidence. When you predict, you become attached to being right. When you react, you remain flexible and open. Liquidity sweeps are designed to exploit mental weaknesses. Impatience, ego, FOMO, the illusion of control. By mastering these weaknesses, you make the sweeps irrelevant. They become noise, nothing more. When you wait for retests, define invalidations, size properly, and react instead of predict, you build psychological armor. Sweeps happen, but you're not in them. You sit on your hands, confident and calm. Emotional immunity. Traders often search for an edge in the form of hidden indicators or secret algorithms. But the real edge is emotional immunity. Trusting your system even during drawdowns. Cutting losses without hesitation. Staying out when nothing aligns. This is what separates amateurs from professionals. Richard Dennis, the turtle experiment founder, understood this deeply. He didn't pick his turtles based on market knowledge or technical expertise. He picked them based on their ability to follow rules without emotional interference. The psychological setup of a liquidity sweep. Let's break it down step by step. 1. The setup. An obvious resistance level forms after a sustained rally. Everyone watching starts to think, if price breaks here, it's going to the moon. 2. The bait. Price slowly approaches the level, creating tension and anticipation. The quiet periods lull you into comfort. 3. The trigger. A sharp breakout candle pierces resistance. Retail traders pile in. 4. The trap. Price immediately snaps back inside the level, taking out stops. Weak hands panic, selling into the reversal. 5. The real move. Once liquidity is cleared, price resumes the true trend, leaving emotional traders behind. How to protect yourself. Mark major levels clearly but don't worship them. Use alerts, not alarms. Let the market come to you. Train yourself to wait for a retest and watch volume or momentum confirmation. Journal every trade. Did you act on evidence or emotion? Case study. The 1980 silver squeeze. In 1980, silver exploded to record highs, driven by the Hunt brothers' accumulation. Thousands of traders joined late, thinking silver would go to the moon. The price spiked above resistance levels, triggering mass buying. Moments later, regulators and big institutions intervened, causing a violent reversal. Those who waited for confirmation or understood the liquidity dynamics avoided catastrophic losses. Those who jumped in blindly were ruined. Trading isn't about constant action. It's about precision and patience. When nothing aligns, sit out. When sweeps happen, sit out. When you feel emotional, sit out. Sitting out is a position. It's a choice that protects your capital and mind. Before each trade, ask, am I entering because I see proof or because I feel the need to act? If the answer is emotion-driven, stop. This simple question can save you from years of pain and account-destroying mistakes. Every time you see a breakout, whisper to yourself, is this move confirmed by the market, or is it bait for the impatient? The best trades feel boring, quiet, almost obvious. They don't scream at you. They patiently wait for you to step in with clarity. You don't have to catch every move. You don't have to avoid every fake out. You just need to avoid the big traps and let real trends pay for everything else. Be patient. Wait for confirmation. Trust your invalidations. Size smart. React. Never predict. And above all, master your emotions. Become the second mouse. Trade like a turtle. Alas the noise. And watch your trading journey transform beyond what you ever imagined. Every major blow-up starts with the same small seed. One emotional trade. One undisciplined moment. One liquidity sweep that should have been avoided. Your mission as a trader is not just to find winning trades. It's to protect yourself from your own worst tendencies. By mastering these turtle-inspired principles, you're not just avoiding sweeps. You're building a foundation that can weather storms, fake-outs, and all the psychological games the market will throw at you. That is the real edge. That is what makes legends.